Hello everyone. Today I have a different type of video. Essentially, I have a problem with the efficient market hypothesis. Now, this type of video, it's going to be more of a personal vendetta, as currently in my undergrad, we go over the efficient market hypothesis, and how it's been introduced to a lot of us is, in essence, explaining that the strong form of the efficient market hypothesis is correct. And so today I'm going to kind of introduce what the efficient market hypothesis is, a few different types of the theory, such as the weak form, the strong form, the semi-strong form, that all show varying levels of efficiency. Some of my points as to why I don't necessarily think markets are efficient, and lastly, how you can use this information to actually change your own investments and whether any of this has any relevancy to the average investor or even somebody who just wants to dollar cost average into an ETF that tracks an index. So, essentially, the efficient market hypothesis is a sort of model, it's kind of a theory that all available information is already priced into the markets. And this means there's no chance for arbitrage, there's no pricing mismatches, that all relevant information is taken into account, and different companies in the markets are accurately and appropriately priced at all times. Now, obviously, at least it comes obvious to me, someone could look at this and be like, isn't there a chance for retail investors to, such as we saw during COVID, have a GameStop opportunity? And that wasn't necessarily from undervalued, but certainly that wasn't priced in for the hedge funds that, hey, everybody at once is going to rally behind a company and just push it to an extreme level and make us eat our shorts, in essence. But yet we still have the efficient market hypothesis and are taught that markets are efficient. And for the most part, I think they are. I think for the most part, they are accurately efficient. That being said, I wouldn't go as far as to say all relevant information and all pricing is correct at all times. And you have greats like Warren Buffett, who, even though he's been an active manager and he's made the majority of his money being an active manager, issued the challenge where, hey, I'm going to see and put to the test and put my own money on the line who out of the fund managers can outperform the markets. And even though nobody was able to do it and nobody was able to win on his competition that he set out, I wouldn't say that this accurately shows that there are no arbitrage opportunities, because of course there are. I would take the step and say that of the S&P 500 companies, like when we really divide the market into very large cap companies, I'd say that it's more likely the higher up you go that those are priced accurately, where there's a lot of coverage, where there's a lot of analysts, where there's a lot of recommendations, and the majority of people throughout the day, that's where you see the highest volume, as opposed to smaller cap stocks and foreign and international stocks that maybe don't get enough coverage, and you see opportunities there where they'll have very, very low PEs on growing and established businesses themselves. So really quickly, the three forms that we kind of all get introduced to is the weak form, which I think is absolutely terrible, which is that no relevant information is accurately priced in, tons of opportunities for arbitrage. Now, of course, there are opportunities for arbitrage, but more or less the weak form indicates that markets are not efficient at all. Then we have the semi-strong, which currently at this point in time I tend to find should be how we should accurately approach the efficient market hypothesis, which is basically the majority of times markets are efficient, but there are opportunities for arbitrage, and all public information that we get is taken into account immediately. And then there's the strong form, which again, as I've gone over, is all information is accurately reflected in the pricing of the stock market at any given time and the stocks in it. All public information is properly, and key emphasis on properly, shown in there. Now, where I kind of have a problem with this is, well, even when you go to any single earnings season, a lot of times what you'll see is a company will, let's say they miss, but they miss their earnings, but they have strong growth and everything, and they're punished heavily for it. A lot of times, what I've found is that these companies that have a drop 8%, 10%, sometimes even more out of the big companies, the next day you'll have a rebound day as everyone kind of adjusts to it and says, hey, wait, this was an overreaction. I think overreactions, both on the positive side and on the negative side, are an indication that maybe they aren't necessarily fully efficient, but instead are semi efficient. So it should have been a drop to, let's say, 6% as opposed to 8%, and the public kind of catches onto it. And now, once it is dropped far enough, it becomes more of an attractive company to purchase at that specific price. Now, again, one of the things with the efficient market hypothesis that, while I don't necessarily believe the strong form is correct, I would still see it as an added benefit, is that the efficient market hypothesis persuades a lot of people out of active investing, which active investing, when done properly, I think can present opportunities to both gain a little bit more and lose less than the market at times. And I really like active investing, but I wouldn't recommend it at all for the average investor who doesn't have time. Right now, I'm a college student. I have lots of time outside of class to research different stocks, check up on things in my portfolio, keep up with relevant news on tariffs and the political landscapes and international stuff even, and I have plenty of time to pour in those hours of research and try and find undervalued opportunities. But for the average person who works a 9 to 5 job, they probably shouldn't be active investing to the point where they don't actually understand what that management team's done, what their experiences are, the direction of the company, not just up or down, obviously, but like what the next steps are, what the products are that they're trying to push out, any of that. It's hard to actually value a company like a business or value the stock based on business principles at all if you don't have time to research it. And so, what the efficient market hypothesis, if markets are fully efficient, does, which I really like, is it pushes people who would active invest and don't really know that much and would probably try and time the market or go in when there's lots of greed and prices have been very, very strong, and they just simply go like Mag 7, put their whole portfolio in at a top, and then eventually when there's a correction, probably panic sell because it's hard to look across the dinner table and be like, hey hun, I lost 100,000 of our retirement fund by investing. Obviously, investing to most people means making money. It's not going to be an easy explanation. Don't worry, we're just going to be long-term investing from here on out. So again, I think the efficient market hypothesis pushes people to be more passive investors, more long-term focused, maybe dollar cost average into things that track the market, such as a VOO or a SPY or anything of that nature. And that's something I really do like that comes from the efficient market hypothesis, is it tells people that you can't necessarily win by active investing, which, while I don't think all the time is true, I do think for most individuals that is true, and the statistic would back that up. However, when we start looking at individual things that kind of break the efficient market hypothesis, I've already brought up the power that retail investors have had in the past, and I think a great example of that would be Nvidia these past few years. Everybody pushing into Nvidia. A lot of times we will see major drops in specifically the share price, but a lot of people don't actually spend that much time into the PE valuations. They hear AI, they think iRobot, they don't do enough research into the company. Some people I've talked to who invest in Nvidia in my age bracket don't even know who Jensen Huang is. So again, retail investors have a certain amount of power. While we like to keep up with these big institutional investors because at any given point they have a much, much larger sum, retail investors do in a lot of ways still dictate and drive markets. Now, I think that's going to slowly die out, but for right now, there's still a lot of power there. And in a similar theme, I don't want to go out and say AI is a bubble. I absolutely do not think it is when people compare it to the dot-com bubble. That's a different conversation, but the existence of bubbles, I would say, means that markets are significantly less efficient. When we really think about it, what is stopping us from going through another Dutch tulip craze? At this point, what does the market do that prevents that? it really doesn't do anything to stop that. And when we look at something like the dot-com bubble, where companies could just slap in that they were going to be focusing highly on their internet operations, there there wasn't really enough checking at the time. It all kind of collapsed at once, but for a lot of people, you had the opportunity to make money on companies that really didn't even have a claim in the internet space. And I do think that there are companies like that with AI, just by simply how many companies say they're really focused into AI and strong in AI, when it really comes down to a handful of players who are making the big improvements right now. But again, that's a different conversation on whether or not the AI bubble, as people like to say, is anything comparable to the dot-com bubble at this given point. Now, certainly we could see that with the emergence of a ton of different AI companies that are crappy, for lack of better terms. I mean, when we look at the dot-com bubble, the companies that got wiped out completely were terrible, and the Amazons, Googles, all of that lived through the dot-com bubble. But the existence, going back to the efficient market hypothesis and my original tangent, the entire the existence of bubbles, I would say, is a clear indication that maybe the efficient market hypothesis in semi strong form is more accurate than the efficient market hypothesis either being at strong or weak form. Now, lastly, I have on here value companies being stronger than growth companies, which I think is a pure indication of the efficient market hypothesis. And kind of what I wanted to go with on that was that at any given point, a lot of what impacts your returns is going to be the price at which you acquired a great company or a solid investment opportunity. It's not even so much you can invest in a terrible company at a very attractive price and make money. And I think that simple, like that right there, is a strong indication that the semi strong form of the efficient market hypothesis is correct. I mean, when we look at the origins of Warren Buffett, it was all these cigarette butt companies really before Charlie Munger got involved, and he was still able to make quite a large sum of money. And consistently, value stocks have beaten growth. Now, these past few years, growth have definitely beaten value, but historically, value companies have beaten growth companies, and a lot of that comes down to more attractive valuations and chances for arbitrage, especially in companies that the market has completely overlooked for these fast and exciting names, driven up the price, and then watch them fall off the cliff, like Tesla, even though there are some other factors leading to that Tesla fall off. Okay, thank you. That was really it. I just had a massive problem with the efficient market hypothesis, and for some reason in academia, I keep seeing it, and not only that, they want to push the strong form of the efficient market hypothesis. So, thank you for that.